Good afternoon, everybody. Welcome to the weekly economic update for May 23rd, 2022. Hope everybody had a great weekend. It was snowy here, so I've been trapped in my house for 3 days. so, but better days in the market today. Again, don't let this dead cat bounce get anyone too excited. We would certainly need to see more of a longer term trend to think that this is the end of the slide. Personally, I'm more on it's the beginning, but again, I don't have a crystal ball. Don't claim to see the future, but that's just my best guesstimate right now. First time watching, please give me one of these big thumbs up, and please, if you need to reach me, you can find me at dsafinancialgroup.com. It's right here on the screen next to my email address. All right, well, let's go ahead and jump in and take a look and see how the markets performed today. Dow Jones was up 1.98%, closing at 31,880. SP 500 was up 1.86%, closed at 3973. NASDAQ up 1.59, closed at 11,535. Small caps are up almost, about almost a percent at 0.88. The VIX pulled back 3.23% today. It's currently sitting at 2848. Moving on to the other exchanges here in the Americas, Canada was flat. It was up 0.08. Brazil was up 1.71. Mexico was down 0.27. Headed over to Western Europe, looks tons of green. Germany was up 1.38, the UK up 1.67, France up 1.17, the Euro stocks up 1.4, Netherlands was up 1.62, Spain up 1.67, Italy was flat, it was only up 0.17, Switzerland was up 1.39, Portugal up 2.67, Belgium up 0.39. Austria was up 1.83 and Sweden up 1.24. Denmark was down 0.32. The Russian exchanges were mixed. The MOEX was down 3.01. The RTSI was up 1.12. All right, let's move down to the Asian markets. Japan was up 0.98. Australia was flat. It finished up 0.05. New Zealand was up 0.59. Looks like the Chinese markets were mostly in the red today. Shanghai finished flat at up 0.01. The SE component down 0.06. The China A50 down 0.97. The DJ Shanghai down 0.09. And the Hang Seng down 1.19. And the Taiwan weighted finished flat at up 0.07. So for most of the day, things look pretty good, especially in Western Europe and here in the United States. So certainly some good news there. Gives us a bit of a relief from the downturn we've been in. Let me bring up my chart here. And we can see that this starts here. This trend line begins at the beginning of the year. And we can see that each time we hit this point of resistance, it bounced back down. We did go through it for a short period in late March and through April, but we've since gotten back within this line. So if we were to break through, if this uptrend were to continue from Friday today and go up and crash through this, then hey, I'd say sure, we have the possibility of a leg up for I don't know however long that trend would continue. But again, we've kind of resumed this downward trend. So again, don't get too excited. We in the business call this a dead cat bounce. And they are quite frequent, especially in, actually, let me bring my chart back up and we can go back to, go back to 2008 and 9. Let's shrink this timeline down. And then, you can see at the the slide back at the mortgage meltdown, more than a decade ago, really began, let's see, about the peak was October 12th of 07. And you can see where we had several upswings at 7%. This one was up about 7% also. And that was about 6%. So you can have certainly in these, longer term downtrends, an uptrend for however long that was. That was about 2 months. I mean, that was a 2 month stretch where, it was trending back up, but it certainly didn't, break the longer term trend. So anyways, just some food for thought for the amateur stock traders out there in the world. So, all right, well, let's go ahead and read through today's weekly economic update. The week on Wall Street, recession fears grew last week following weak earnings reports from major retailers sending stocks lower. The Dow Jones Industrial Average fell 2.9%. The S&P 500 lost 3.05. The Nasdaq dropped 3.82, and internationals actually gained 0.84. Trending lower. Stock prices remained in a downtrend, capped off by selling on Wednesday following a succession of disappointing earnings reports from several major retailers. Despite solid April retail sales and industrial production data, weak economic numbers from China and shrinking profit margins at U.S. retailers fanned recession fears throughout the week. Rising yields, which have been an overhang to the markets in recent weeks, turned lower as investors appeared to move cash to bonds from stocks. But lower yields did not help the stock prices, which closed out the week with a volatile trading session. Cloudy picture with retailers. Investors received a mixed message from the retail sector. April's retail sales increased zero point 0.9 from March, signifying that consumer spending remained strong, but it was difficult to determine from the retail sales report whether the increase was a function of higher retail prices or a resilient consumer. And that's something I brought up a lot in meetings over the last couple of months. While the consumer spending looks good on paper, is it that people are just paying more for the same stuff? Or are they paying more for less stuff? So it is a little tough to tell. It was also a big week for earnings from some of the nation's largest retailers. Results were disappointing as retailers struggled with supply chain issues, higher costs, and a misaligned product mix. Some retailers indicated a drop in the number of transactions, suggesting that shoppers reduced purchases due to higher prices on essential items. All right. Economic data coming out this week. We have the Purchasing Managers Index Composite Flash and new home sales on Tuesday. Wednesday, we have the FOMC minutes and durable goods orders. Thursday, we have gross domestic product and jobless claims. And Friday is the consumer sentiment. Companies reporting earnings this week. Today, we have Zoom. Tomorrow is Best Buy, AutoZone, and Intuit. Wednesday is NVIDIA and Snowflake. And Thursday is Costco, Marvel Technology, Workday Inc., Dollar General, Dell Technologies, and VMware. All righty. So let's go ahead and jump into today's market recap. Dow makes strong start to week as banks and tech shine. The Dow climbed Monday, buoyed by a JP Morgan-led jump in banks and a rally in big tech as the dip buying seen late Friday continued into the start of this week. JP Morgan racked up more than 6% after the bank lifted its guidance on annual performance, forecasting net interest income to exceed $56 billion in 2022, above the prior forecast in January of just $50 billion. Banking stocks have been under pressure recently as fears about recession offset expectations for higher interest rates as the Federal Reserve is set to step up the pace of monetary policy tightening. JP Morgan, while acknowledging that the risk of, quote, future adverse outcome, end quote, has increased, downplayed the risk of recession, pointing to a U.S. economy that, quote, remains fundamentally strong, end quote. The positive outlook from JP Morgan sparked a rally in several banks, including Citigroup, Wells Fargo, and Bank of America. Energy stocks, meanwhile, rose more than 2% as oil prices wavered between gains and losses, despite growing expectations for a boost in energy demand as Shanghai prepares to reopen after a 2-month COVID-19 lockdown. Schlumberger, APA, and Coterra Energy were up sharply on the day, with the latter rising more than 5%. Technology, which has led the recent market rout, continued to build momentum seen late Friday, with Apple, Microsoft, and Alphabet leading the gains. Airbnb was marginally higher, shrugging off a CNBC report citing unnamed sources that the company is set to shut down its domestic business in China by this summer. In deal news, VMware soared more than 24% on reports that the software company is in talks to be acquired by chipmaker Broadcom for about $140 a share. If the deal goes through, it could, however, attract regulatory scrutiny despite a lack of business overlap between the firms. Quote, our concern is the potential that regulators block the deal. While we don't see the business overlap that traditionally has created regulatory scrutiny, we would argue such overlap didn't exist with Avgo's proposed QCOM acquisition, nor QCOM's aborted efforts to buy NXP, Wedbush said. All right. So, some good news coming out of the markets today. I mean, businesses will survive, whatever happens to us. I mean, I'm not overly worried about, going back to, sticks and rocks like cave people. but there will be some consolidation. I think there will be some new businesses and industries that'll come out of whatever the phoenix of the burning fire of whatever this bear market will bring. But anyways, all right. And then one last article today comes from the Wall Street Journal. Conditions are ripe for a deep bear market. It's written by James McIntosh. This text a little bigger. Oh, didn't work. With the S&P 500 briefly on Friday down 20% from its January peak, it is tempting to start trying to call the end of the sell-off. The problem is that only one of the conditions for a rally is in place, and that's everyone's scared. That worked beautifully for timing the start of the 2020 rebound, but this time around may not be enough. The other requirement The other requirements are that investors start to see a way through the challenges and that policymakers start to help. Without those, the risk is a series of bear market rallies that don't last. Hey, we just talked about that a second ago, hurting dip buyers and further damaging investor confidence. The let's see here. That the confidence is already weak. Surveys of sentiment show fund managers surveyed by Bank of America, private investors, that the American Association of Individual Investors and financial newsletters, Investors Intelligence, are already at March 2020 levels of caution about stocks. Options that protect against market falls haven't been so popular since back then either. And consumer sentiment, a measure of by the University of Michigan, is actually worse than it was then. And I think that's what this chart shows here is where we stand today versus where we were. Well, actually, we're about where we were in getting close to where we were 2 years ago. Oh, this is the chart here. So yeah, we're actually worse than where we were in March 30th. So in 2020, that was enough because central bankers and politicians were frightened too. When they stepped in, it helped investors see that with government support, companies could make it through. And a lot of people call that the Fed put. When anytime that the market wavers too badly, the government comes to the rescue with a big wheelbarrow full of money and dumps it into the economy, fixes everything. Well, we can see what what the result of that is a lot of inflation that we weren't really prepared for. All right. This time, central bankers are scared not by following markets or economic outlook, but by inflation. Sure, if something major breaks in the financial system, they will refocus on finance, and a recession may prompt them to rethink rate rises. But for now, inflation means that falling stock prices are seen merely as a side effect of tighter monetary policy, not a reason to invoke the Fed put. Hey, I just said that. And rescue investors. There's nothing magical about a fall of 20%, the usual definition of a bear market, but it does crop up a lot. In the past 40 years, the S&P 500 has bottomed out with a 20% or so peak to trough decline 4 times in 1990, 98, and 2011 and 2018. Another 4 times it had far bigger losses. A true panic took hold. The common factor in the 20% drops was the Federal Reserve. Each time the market bottomed out, when the central bank eased monetary policy, with the stock market's fall, perhaps helping push the Fed to take the threats more seriously than it would otherwise. My concern is that this time could be more like 1973 and 1974. Just as then, the primary concern of the country is inflation, thanks to a war-related oil price shock. Just as then, the inflationary shock took hold when the Fed had rates far too low, given the scale of political stimulus for the economy. Just as then, favored stocks, the Nifty 50, now the FANGs and associated acronym, had soared in prior years. Most important, in 1974, the Fed kept raising rates even as recession took hold because it was running to catch up with inflation. The result was a horrible bear market interspersed with soul-destroying temporary rallies, 2 of 10%, 2 of 8%, and 2 of 7%, each snuffed out. It took 20 months before the low was reached, not coincidentally, when the Fed began to get serious about cutting rates. So far, this time has been nothing like as bad for stocks, not least because the economy isn't in recession. If inflation comes down, the Fed won't need to raise rates as much as it has indicated, which would be a big boon for stocks that have suffered the most. I'm still hopeful that the economy will prove resilient, although it will be a long time before we know enough to make a good bet on it. In really simple terms, though, after stocks more than doubled in 2 years, the market fall of more than 20% seems entirely plausible. Again, a lot of folks are comparing what we're headed into right now, a lot like the stagflation of the 70s. I was a little kid back then. I had didn't really care about that sort of stuff. But if you were around back then and were in the workforce, I'm sure you're probably really aware of what it was like with high gas prices and stagnant wages and things just getting more expensive. All right. Well, that's everything I had for today. I hope everyone has a fantastic evening. I'll be back tomorrow with the Liberty Call. If anybody needs anything from me, please go to dsafinancialgroup.com and have a wonderful night. Bye bye.